You know how it is. You're sitting there, reading up on a company. You think you've got it all figured out. You hit buy, and the market does the exact opposite. That's exactly how my investing journey started. A little painful, sure, but definitely effective. Hi everyone, welcome to Market Compass. I'm Adam. I've been investing for over a decade, and for most of that time I did it quietly. No audience, just for myself. I read a lot, messed up a lot, paid for my mistakes, and slowly started to understand how this market actually works. Back in 2008, I did exactly what I warn you against today. I got out too late and jumped back in too early. I lost money and a few months of good sleep. It was the most expensive lesson of my life, but also the most valuable. But hey, this isn't just a me problem. This pattern of making mistakes is surprisingly universal. Studies by the DALBAR Institute show that over the last 20 years, the stock market grew by almost 10% annually, while the average investor pulled in less than 7%. Over a lifetime, those 3 percentage points can mean having half as much money in retirement. And it's not because of market crashes, it's because of us. Our emotions, our lack of a plan, and making the wrong decisions at the worst possible time. The pain of losing $1,000 hits your brain twice as hard as the joy of making that same amount. That loss aversion is exactly why we panic sell at the absolute bottom and buy in pure euphoria at the top. I know this from personal experience far better than I'd like to admit. What is Market Compass? I want this channel to be my public investment journal. I'm going to show you how I analyze the market and how I think. And when reality completely derails my scenario, I'll show you how I react to that too. Because there's no such thing as an investor who doesn't screw up. There are only those who come out smarter on the other side. We'll be talking about global stocks, dividends, psychology, and risk management. I'll also share real moves from my own portfolio, what I'm buying, why I'm buying it, and what my expectations are. Let me be clear right off the bat. You won't find any videos here hyping up stocks guaranteed to give you 300% returns in 6 months. We aren't guessing what the market will do tomorrow. We're focusing on the process, managing risk, and making better decisions. Remember those 3 percentage points I mentioned earlier? That's where the difference lies between the people who lose them and the people who keep them. It all comes down to what you do and why you do it. Drop a comment and let me know what you want to learn or what I should cover in future videos. All I ask is for mutual respect, because this is a space for everyone, no matter your experience level. So, now that you know who I am, let's get into the meat of it. Let's take a look at where the market stands today. Everywhere you look, people are predicting an imminent crash. One of their main arguments is market breadth, basically the percentage of S&P 500 companies trading above their 200-day moving average. As you can see on the chart, right now it's only sitting at about 55%, while in a classic broad bull market, that number is closer to 75%. At first glance, that sounds pretty alarming, but before we jump to conclusions, let's take a step back. The concentration of massive amounts of money in new tech is nothing new. Just look at this study. They analyzed every single publicly traded company for almost the entire 20th century and then ran the numbers for the whole world. The result was always exactly the same. A mere 4% of companies account for absolutely all the wealth generated in the stock market. Simply put, a handful of players take the lion's share. It was exactly the same story with the internet, smartphones, and the cloud. What we're seeing right now with AI isn't a glitch in the matrix. It's the oldest pattern in capital markets. Tech historian Carlota Perez provides some great context here. She outlines a predictable pattern that accompanies every major technological revolution, whether it's railways, electrification, cars, or the internet. There are always 2 phases. First, there is the installation phase, which brings massive investments, speculation, a bubble, and a crash. Then comes the deployment phase, marked by real productivity gains, monetization, and broad, widespread growth. Perez puts it bluntly, right now, AI is right in the middle of the installation phase. Big tech's massive capex isn't madness, it's laying down the train tracks before the era of mass rail travel begins. The real question isn't whether this is a bubble, but rather, when does the deployment phase start and who's going to make money off it? Microsoft alone has announced capital expenditures of $80 billion for fiscal year 2025. The combined capex of the four biggest hyperscalers, Microsoft, Amazon, Alphabet, and Meta, was around $217 billion in 2024. Even back then, that sounded like an astronomical number, and the forecast for 2026 points to nearly $610 billion. That's 3 times as much in just 2 years. This isn't just evolution, it's a total paradigm shift. And this is where Ms. Perez comes back into the picture. Building railways looked like absolute madness too, until the trains actually started running. But there's one aspect that rarely gets brought up in these AI conversations, and it might dictate the pace of this bull market more than the valuations of tech companies themselves. Energy. A data center for a single large language model uses as much electricity as tens of thousands of households. Goldman Sachs estimates that data center power demand in the US will surge by 160% by 2030. In other words, utility companies and grid infrastructure manufacturers could turn out to be one of the most underappreciated sectors of this entire revolution. Now, of course, this is where I hear the most common counter-argument. But Adam, they said the exact same thing before 2000. Let's look at the hard facts. Take Pets.com. In 1999, they spent 20 times more on advertising than they actually brought in. They went bankrupt exactly 9 months after going public. Or look at Palm. In March 2000, for a brief moment, it was valued higher than Apple, Amazon, Nvidia, and Starbucks combined. Not because they had a better business, but because investors were buying a story, not actual results. Today is an entirely different story. At the peak of the dot-com bubble, the forward PE ratio for the tech sector was over 70 or 80. In plain English, investors were paying $80 for every single dollar of profit a company might generate in the future. And they were doing this for companies that were earning absolutely nothing at the time. Then you have the Shiller-Cape ratio. Think of it as the stock market's lie detector. It looks at a company's earnings over the last decade to see if it has solid fundamentals or if it's just a flash in the pan. In December 1999, it hit a record high of 44. And today, that same ratio for the Magnificent Seven is hovering around 30 to 35. It's high, sure, but we're talking about revenue growth of 15% to 20% a year and massive returns on capital. Nvidia alone generated over $26 billion in pure free cash flow in 2024. That is the fundamental difference, and the lesson we need to take away. The 2000 bubble sold dreams and promises. Today's market, at least at the very top, is selling cold, hard results. Of course, the market can be fickle. The best example of this is the Nasdaq Emerging Cloud Index, which in my opinion is the ultimate barometer for cloud-based businesses. What actually happened there? Terrified that artificial intelligence would destroy their business models, investors massively dumped SaaS stocks, which led to a sharp bottom at the end of the first quarter of 2026. Those who let their emotions take over locked in their losses. Those who stayed calm were rewarded with a strong rebound. The market quickly realized that good companies will simply adapt. The current correction is completely healthy and doesn't change my long-term approach to this sector at all. Data and fundamentals beat panic. Every single time. So how might this bull market end? I'm not going to play fortune teller, but I will tell you what I'm keeping my eye on. As long as big tech's capex doesn't exceed their ability to self-fund, and as long as their quarterly earnings don't disappoint, I just don't see any basis for a permanent trend reversal. The second one of those signals flashes red, I'll be the first to let you know. We already know the AI bull market has real fundamentals. We know valuations at the very top are high, justified, but certainly not cheap. Remember those 3 percentage points from the beginning? This is exactly where you decide whether you lose them or keep them. In the next episode, I'm going to show you my starting point. Not just ready-made decisions, but something way more important, the underlying mechanism. Where I start, which markets I even consider, and why a few of them might actually surprise you. It's an episode for people who want to know how to think before they start clicking buy. Let me know in the comments what interests you most for future videos. Specific stocks, risk management, or maybe the psychology behind investing. I'm listening to you, and you guys are going to help shape the direction of this channel. Make sure to hit subscribe so you don't miss the next episode. See you next time. The content published here is strictly for educational purposes and does not constitute financial or investment advice.